Welcome to another edition of one of our Money Talks videocasts. I'm Jerry Slusiewicz, your host. Going to talk to you about kind of the 2010 review. It was a very difficult year. While the markets ended up at the end of the year, they started positively and ended positively, but in the middle was quite a whipsaw. By about the springtime, the Federal Reserve Chairman Ben Bernanke was talking about ways to sop up the extra liquidity that was in the system and basically try to, maybe even have interest rates start to go up by year end or the beginning of 2011. Well, by mid to late April, the markets became shocked about rising interest rates and whether the economy was strong enough to stand on its own, and it sent shockwaves to the system, including the one-day, now infamous flash crash where the market dropped intraday almost 900 points, or actually closer to 1,000 points on the S&P or on the Dow, and 100 points on the S&P. Pretty significant, 8.5% one-day drop. It was a pretty significant move. That didn't end at all. I mean, while the markets recovered the next few days, by early July and certainly not really until the end of August, markets were down around 17-18% from peak to trough. So they really sputtered a lot during the summer. And if you looked at emerging markets, things like Asia, you started looking at some of these European countries, the PIG countries, Portugal, Ireland, Greece, Spain, Ireland, I think Italy, another one out there. Things were pretty tumultuous over there in Europe as well. And some of those markets were down over 20-25%, which is bear market territory. Ben Bernanke, Fed chair, realizing that this looked very troublesome for our markets, came up with a plan, and that was to throw more money at the system. Quantitative easing too, which is just, since interest rates were at zero, how can they create more money into the system? And that was to basically buy treasuries, monetize the debt, and they're buying it from the primary broker dealers. The hope was that these broker dealers, when they get these billions of dollars per day, every day, that they would look around and say, well, geez, we can repair our balance sheet some more, we can lend it out, which lending is pretty dead, or we can maybe invest in the stock market. So the thought was to keep interest rates low, drive stock prices up. Well, it worked to the side of driving stock prices up. There's no doubt from September through the end of the year, the markets rallied on this managed system of Fed easing. But in the end here, what we've also seen is interest rates start to go up. Now, is that a function of people who had rushed to the safety of bonds over the years, now saying that maybe they could take some risk in their portfolio, or are the bond vigilantes out in full? And that remains to be the million-dollar question as we head into the new year. Again, I'm taping this on New Year's Eve, December 31st, 2010, our last video cast of the year. So that's the big question, is what's going to happen next year? I think the markets, they were artificially held up heading into year end. Money managers wanted to make profits. I think we might see, we'll know within the first couple of weeks of the year whether or not we're going to see an early season correction, maybe as much as 7 to 10%. But the Fed's going to keep doing what they're doing in terms of pumping money into the system, and they're going to try to hold this market up as best as possible. The wild card is interest rates. If interest rates really start to spike up, if we do start to have this hyperinflation, which will mean we'll have inflation first, the economy will continue to recover, we'll get into a growing spell, it'll be continued growth, and then it can overheat. That's going to take some time to see. I mean, we certainly won't see that in the early part of the year. But my thought is we get a near-term correction, maybe even things like gold and silver, which had great end of year. Some of the soft commodities like cotton and sugar and things like that might sell off, copper as well, and then they might be great buys sometime after the first couple months of the year, because I do think that the Fed's going to do what they can. They're going to continue to print money. They're going to continue to try to inflate our way out of our problems. They're going to continue to monetize debt, which will weaken the dollar. But it's not like the Europeans are much stronger, or the Japanese are much stronger. All these currency commodities are in trouble. That's why I think gold and silver will continue their ascent, although be it after some near-term correction. That's kind of my recap of 2010, forecast for 2011. Again, same with the stock market. We're going to have a near-term pullback. But for now, I think the stock market's going to continue to be managed in an upward direction. Again, sign up for our free educational newsletter. It's right here on our website, right up above my head. It says free educational newsletter. All we need is your email address. Sign up for that. Call me toll free, 800-449-9501, 449-9501 for our free, no obligation portfolio review. Start the year right, get a second opinion. We can help you. There's no obligation for the review. The call is free, the appointment's free. And again, best wishes to you. Happy New Year. Best wishes for health, happiness, prosperity in the new year. Give me a call. I know I can help. Have a great time.